Right now, while you're watching this video, an artificial intelligence is managing over $1 trillion of people's money. It doesn't sleep, it doesn't take lunch breaks, it doesn't panic when the market crashes, and it charges you a quarter of what a human financial advisor would. But here's the part that should really get your attention. Over half of all adults in the United States have already asked AI for financial advice. More than half. That's more people than have ever spoken to a human financial advisor in their entire lives. And Wall Street? The biggest hedge funds on the planet aren't just using AI on the side. AI now handles almost 90% of all trading volume worldwide. 90%. The robots aren't coming for your financial advisor. They're already here. They already have the keys. And most people haven't even noticed. So the question isn't if AI is replacing financial advisors. The question is, who actually wins when that happens? Is it you? Is it Wall Street? Is it the guy who can't afford a financial advisor in the first place? Because the answer isn't what you'd expect. To understand what's changing, you need to understand what it was like before. For most of modern history, if you wanted someone to help you invest your money, you had one option: find a financial advisor. A human being, in a suit, behind a desk, and that person would charge you about 1% of everything they managed for you, every single year. 1% might sound small, but let's do the math, because nobody ever does. If you have $100,000 invested, 1% means you pay $1,000 a year. Okay, that's not terrible, but if you have $500,000, that's $5,000 a year. $1,000,000? $10,000 a year. For decades. Over a 30-year period, that 1% fee can eat up hundreds of thousands of dollars from your retirement. Money that would have been yours, gone, to pay someone who in many cases just puts your money into the same index funds you could have bought yourself. And here's the part that makes it even worse. About 30% of financial advisors in the US aren't even required to act in your best interest. They're allowed to recommend investments that pay them more in commissions, even if cheaper, better options exist for you. They're salespeople with fancy titles. Now, I'm not saying all financial advisors are bad. Some are genuinely great. They do tax planning, estate planning, behavioral coaching, stuff that's really valuable. We'll come back to that. But for basic investment management, picking which funds to put your money in and rebalancing it once a quarter, that job was ripe for disruption. And disruption came with a very quiet name. In 2008, two companies launched that would change everything: Betterment and Wealthfront. The idea was almost insultingly simple. Instead of paying a human 1% to put your money into index funds, what if a computer did the exact same thing for a quarter of the price? You fill out a questionnaire online. How old are you? When do you want to retire? How much risk are you comfortable with? The algorithm processes your answers, builds you a portfolio of low-cost index funds, and automatically rebalances it for you. No meetings, no phone calls, no minimum investment of $250,000 just to walk in the door. The cost? About 0.25% of your money per year. Compare that to the typical human advisor charging 1%. That's 4 times cheaper. On a $500,000 portfolio over 30 years, the difference between 0.25% and 1% in fees is staggering. We're talking about well over $100,000 in extra money staying in your pocket just from lower fees. The investments are essentially the same. The only difference is who's clicking the buttons, and it worked. By 2025, robo-advisors were managing over $1 trillion globally, serving more than 6 million users in the US alone, and around 75% of those users, millennials and Gen Z, people who grew up trusting technology more than they trust a stranger in a suit. The robo-advisor market is growing at almost 30% per year. That's not evolution, that's a takeover. But robo-advisors? They were just the opening act. Because what's happening behind the scenes on Wall Street makes robo-advisors look like a calculator. The world's biggest hedge funds aren't just dabbling in AI. They've gone all in. Bridgewater Associates, one of the largest hedge funds on Earth, launched a $2 billion fund that's run primarily by AI. The CEO said publicly that the AI is generating returns comparable to what their human-led strategies produce. And here's the crazy part. The AI's returns don't even correlate with the human teams. It's finding completely different patterns, completely different opportunities, things human analysts never would have seen. Jane Street, a trading firm that handles around $400 billion in trades every day, committed $6 billion just for AI computing power. They have tens of thousands of high-end GPUs, over 1 exabyte of data storage. They've basically built their own AI supercomputer dedicated to finding microscopic advantages in the market. And they're not alone. Man Group built an internal AI tool that generates trading ideas, writes code to test them, runs backtests, and then sends the results to human reviewers. The AI isn't just assisting, it's doing the creative thinking. Here's the number that should blow your mind. AI now drives roughly 89% of global trading volume. Almost 9 out of every 10 trades happening in the world are being executed by algorithms, not humans, machines. And in 2024, advanced AI trading strategies outperformed traditional quant funds by 4 to 7%. In hedge fund world, that's not a small edge. That's a huge edge. But here's the question you should be asking. If AI can trade better, faster, and cheaper than humans on Wall Street, what does that mean for your money? This is where the story splits into two very different movies, depending on who you are. Movie 1, the optimistic version. Only 35% of Americans currently have a financial plan. That's wild. In one of the richest countries on earth, 2 out of 3 people have no plan for their financial future. And the main reasons? Professional financial advice is too expensive. Minimum account sizes shut people out. And a lot of people are just uncomfortable talking about money with a stranger. AI could fix all of that. A study from MIT published in 2026 found that more than half of American and British adults have already turned to generative AI, things like ChatGPT, for financial advice. And here's the surprising part. The advice was actually pretty good. In simulations, following AI-generated financial plans led to retirement wealth exceeding $1 million in many cases. The AI consistently recommended diversification, adequate savings rates, and liquidity. Sometimes even when the users forgot to ask about those things. The World Economic Forum called AI one of the most powerful potential tools for financial inclusion. If AI can deliver quality financial advice to anyone with a phone, for free or almost free, then suddenly the single mom working 2 jobs can get the same quality of guidance that used to be reserved for people with $250,000 in the bank. That's movie 1, the hopeful one. Now movie 2. The CEO of BlackRock, the largest asset management company in the world, managing over $10 trillion, wrote something in his 2026 annual letter that should make you stop and think. He warned that AI could actually make the wealth gap worse, because the companies with the data, the infrastructure, and the capital to deploy AI at scale will benefit disproportionately. The people who own shares in those companies get richer. Everyone else watches. Think about what we just talked about with hedge funds. Jane Street spending $6 billion on AI. Bridgewater building AI that finds alpha no human can see. These tools aren't free, they're not available to you. They exist to give the already rich an even bigger advantage over regular investors. So AI is simultaneously making basic financial advice cheaper and making the top of the market more exclusive. The floor gets raised, but the ceiling goes up even faster. Who benefits? The honest answer is, it depends on which side of the equation you're sitting on. Now, before you fire your financial advisor and hand everything to a robot, there are real things that AI still can't do. And some of them are the most important parts of financial planning. First, AI can't hold your hand during a market crash. This sounds soft, it sounds emotional, but it's actually the single most valuable thing a human advisor does. When the market drops 30% and every cell in your body is screaming, "Sell everything," a good advisor talks you off the ledge. Studies show this behavioral coaching alone can add 1 to 2% per year to your returns. Not because the advisor picks better stocks, but because they stop you from making panic decisions. AI can send you a push notification that says, "Stay calm, markets recover historically." A human can look you in the eyes and say, "I know this is scary. Let me show you why we planned for this." Those are not the same thing. Second, AI doesn't do complexity well. You're going through a divorce. You just inherited money from a parent who lived in a different country. You own a small business and want to minimize your tax burden across 3 entities. You meet an estate plan that accounts for a special needs child. These are human problems. They involve law, emotion, relationships, and trade-offs that don't fit neatly into an algorithm. A robo-advisor can rebalance your portfolio. It cannot navigate a complicated divorce settlement. Third, the quality of AI advice depends on who's asking. That MIT study we mentioned, it found something uncomfortable. AI-generated financial advice was better when the person asking was more financially literate. People who already understood money got better advice from AI because they asked better questions. People who knew less about finance, they got weaker advice. Same tool, different outcomes. Because AI responds to how you ask, and if you don't know what to ask, you don't get the best answer. That means AI advice could accidentally reinforce the gap between people who understand money and people who don't. So, what's actually going to happen? Because neither extreme is right, AI isn't going to fully replace financial advisors. And financial advisors aren't going to pretend AI doesn't exist. The answer, and the data already supports this, is hybrid. In 2024, hybrid robo-advisors, platforms that combine AI automation with some level of human guidance, already captured over 60% of the market. They're growing faster than pure robo-advisors or traditional advisors alone. The future financial advisor won't be the person who picks your stocks. AI does that better. It won't be the person who rebalances your portfolio. AI does that in milliseconds. It won't be the person who monitors the market at 3 a.m. AI never sleeps. The future financial advisor will be the person who helps you figure out what you actually want your money to do. The one who understands that you don't just want returns, you want to feel secure enough to quit a job you hate, or send your kid to college without drowning in debt, or retire at 60 instead of 67. AI can optimize a portfolio, but it can't optimize a life. And that shift is already happening. One industry commentator described the coming model as the advisory firm of one. A single human advisor supported by AI agents capable of serving 500 clients instead of 100. Same quality of advice, 5 times the reach, dramatically lower cost to the client. The advisors who will thrive are the ones who stop trying to compete with algorithms on data and speed and start competing on trust, empathy, and wisdom. The ones who lose are the ones who are basically just doing what a spreadsheet can do and charging a premium for. So let's make this practical. What do you actually do with all of this information? If you're just starting to invest and your financial situation is straightforward, you have a steady income, you want to save for retirement, and you don't have complex tax issues, a robo-advisor is probably all you need. Seriously, you'll pay a fraction of what a human charges, you'll get a diversified portfolio, and the algorithm will rebalance for you automatically. Start there. Don't overthink it. If your financial life is getting more complex, you own property, you're thinking about estate planning, you have significant assets in multiple accounts, or you're navigating a major life change, that's when a human advisor earns their fee. But choose carefully. Make sure they're a fiduciary, meaning they're legally required to act in your best interest. Ask them directly. If they hesitate, walk out. If you're using AI chatbots for financial guidance, and apparently more than half of you already are, understand the limits. AI gives you a starting point, not a finish line. It can help you think through scenarios, but the quality of the answer depends entirely on the quality of your question. Learn enough about money to ask better questions, and you'll get dramatically better AI advice. And if you're wondering about AI trading tools that promise to beat the market, be very, very careful. The AI that Wall Street uses costs millions of dollars to build and run. The AI trading app that costs $12 a month on your phone, it's not the same thing. The gap between institutional AI and retail AI is a canyon. Don't confuse access to AI with access to the same AI. Here's the truth about AI and financial advisors, stripped down to its bones. AI is eliminating the part of financial advice that was never worth paying for. Basic portfolio management that a simple algorithm handles better, faster, and cheaper than any human ever could. AI is supercharging the richest investors on the planet, giving hedge funds and institutions tools that find opportunities invisible to the human eye, creating an even steeper advantage for the people who already have the most. And AI is opening a door for millions of people who could never afford financial guidance before, offering decent, accessible advice to anyone with a phone, even if it's not perfect. 3 things happening at the same time. 3 different groups benefiting in 3 different ways, and nobody's talking about all 3 at once. The person who benefits most from this shift, it's the one who understands what AI is good at, what it's bad at, and where a human still matters. The one who uses the cheap tools where cheap tools work, and pays for human wisdom only where human wisdom is irreplaceable. That's not a headline, that's not a thumbnail. That's just good financial thinking. And maybe that's the most human skill of all,